Hello, everyone. How are you? My name is John O'Donnell. I'm with Online Trading Academy. It's 9 a.m. I'm in Irvine, California. It seems like we got people here from all over the world. Thank you for coming. Most of you probably know my associate, one of our instructors, Sam Seiden. And I'm want to bring to your attention, by the way, if any of you want my slides I'm going to show you today, you can email me, john@tradingacademy.com. And I believe FX Street is going to record this, so it'll be available on their website as well. There's an old ancient Chinese proverb that says, "Tell me, I'll forget, show me, I'll remember, and involve me, I'll understand." Boy, that certainly applies to trading, doesn't it? Absolutely. Um, the title of my talk today is Globalization 3.0 Power Trading in Uncertain Times. I don't think any of us would disagree with the fact that we truly live in a remarkable period of uncertainty. But yet, if you think about it, when was the most uncertain period of American history? I was thinking about this the other day. People think that uncertain times that we're in today with all this volatility in the markets, including the fact that we've just broken a 34-year trend line. Yeah, write down, give me some feedback here, folks. When do you think was the most uncertain period in the American in the country in America? Well, my analysis is, and if a lot of historians I think would agree with this, no, it was at our founding in 1776. Think about it. The founders of America absolutely took everything and put it at risk. That's right, bullish pig. 1776, when we had a tax revolt against the king, if you recall, the Boston Tea Party. And ladies and gentlemen, and quite frankly, history is littered, if you study financial history, with many, many periods of uncertainty. This chart I'm showing you is a 5-wave cycle from our friends at Elliott Wave, compliments of them, of a 34-year trend line that has been broken. If you go, some say the bull market started in 1974 and ended in 2000. Some say no, it started with Reagan's election right here in 1982. 81 era, and we've broken both the red trend line and the green trend line. And there's a whole group of people today that say that we're in for a traumatic free fall in the Dow, and that I'm not necessarily forecasting that. By the end of the seminar today, you'll know where I stand. But I think we truly do live in a remarkable period of uncertainty, and we're going to have a significant correction in the market. And I want to give you a lot of evidence on why I think that's the case. For those of you that don't know, Online Trading Academy is not a broker-dealer, so you can't open an account with us, but we are an independent school with locations throughout the world, and we teach classes on, we're a for-profit education company. That's all we do. And we do it extremely well. We started in 1997. This was my trading floor in Irvine, California. My partner and I, A.L. Shahar, and we built the largest trading floor west of the Mississippi River, and we would execute on this floor with clients just like you, retail clients, over $500 million a day of trades. Now, we sold this floor 2 weeks before 9/11. We've now morphed our model, and we've become the largest direct access trading school in the world. We're no longer a broker-dealer, but we do partner with multiple broker-dealers that compete to serve our graduates. We have now 25 offices. We'll have 30 offices open across the world. And just go to tradingacademy.com. You can see where all of our centers are located. I could have titled my talk today, Retail Trading Perceptions versus Reality in Today's Globalized 3.0 Markets. And of course, they're very uncertain. And what do I mean by that? Well, there's a gap between your perception as a retail investor trader and reality when you deal with these markets. Now, I've been part of Wall Street since 1968, so that entitles me to say about anything about Wall Street I want to say. But here are the few belief systems, and all of us come to the party each day with a belief system. I don't think we come out of our mother's womb with a buy and hold bias, but I do believe that media, culture, peer pressure, even organized religion impacts our belief system when we come to the market each day. Now, here are a few of the crazy beliefs that are out there, and I'm going to try to put the spotlight on these and dispel many of these beliefs today with some factual price charts. One, buy and hold is safe. Is buy and hold safe? Has buy and hold ever been safe? Well, we don't think so. Is price going down bad? Many of you own a home, I assume. Is that correct? Oh, I misstated that. How many of you own a mortgage with a home attached? Well, in many places across the world today, real estate prices are actually falling. Are real estate falling prices bad? No. My daughter just got married, and they're a young couple, and they needed to start her home in Charlotte, North Carolina, and the fact that home prices are down was very beneficial to that entry-level buyer. So prices going up and prices going down are not necessarily bad or good, quite frankly. It's price change. Are mutual funds a smart way to balance your portfolio? No, we don't like mutual funds. We recommend you own exchange-traded funds. They're a better alternative. And many of you have the position, you don't think much about globalization because you don't think you're impacted by globalization. But in fact, I'm going to show you that we are all impacted by globalization. There's literally no place to hide. And it's going to create some incredible periods of uncertainty going forward, of volatile price change. Now, there's two components to that. One is danger, and we want to preserve capital first at all costs. And, of course, the other is opportunity. And the last one, of course, is one of my favorites. The best time to make money is when the market's going up. Is that true? Is that the best time to make money? Well, this audience is certainly aware that no, it's not necessarily the best time to make money. The best time to make money is to get involved in markets that fluctuate wildly in price. Now take a look at this. I'll show you where the 3.0 fits in. Just be patient. What we really know about markets is that they fluctuate in price. Here's the FTSE. It takes 5 months to go from point A to point B, and it took 5 days to go from roughly 6,100 back to 5,500. In other words, ladies and gentlemen, we can make money in both markets if we recognize that the only thing that is really consistent about markets is that they're going to be volatile and that they're going to change in price over time. Now, that's why we look at charts. Here's the Nikkei index. By the way, I showed this first chart, the one on my left here, to my 22-year-old son, John. Said, John, it takes you 45 minutes to walk to the top of the Empire State Building and 2.3 seconds to come over the edge. I said, boy, Dad, the gravity really sucks. I said, well, son, after you get my age, you'll determine how true that statement is. But in fact, if this is the expression of greed, ladies and gentlemen, and this is the expression of fear, which it is, which emotion is most powerful, greed or fear? Come on, give me some feedback. Is it greed or fear? Get some water. Now, folks, it's pretty obvious. What evidence do you have looking at this chart on the left, and even the chart on the right, that fear is more powerful than greed? What evidence do you have? Well, price change, rapid price change. The greed component took 5 months. The fear component took 5 days. You see, we need to be prepared as traders to make money on both sides of the trend. This is the Nikkei index. From 1985 through 1989, it goes to 38,000. From 10,000, it's collapsed from 38,000 back down to 7,600. And today it's trading at about 12,900, right about here in yen. Ladies and gentlemen, this was an environment where their real estate fell for a long period of time, and we've had a depression in Japan, not a recession, but a depression in Japan for 18 years, in an environment where their central bank took interest rates to zero, and real estate has collapsed down 65% and stayed down. Now, we've seen this phenomenon in the past. This is the dot-com bubble. This is the greed component. This is the fear component. And we obviously have also seen this in the Chinese bubble today. So here's an economy that's been growing at 10% per annum compounded. And just since fourth quarter of 07, we've seen the Chinese market collapse over 50%. I find that regardless of what asset class I look at or what period of time I look at, bubbles are bubbles. They form, they burst, and then we go on to the next cycle. This is sugar. I used to trade sugar back in the mid 70s, where sugar went from roughly 3 cents a pound to 65, 67 cents a pound right here at a peak. And today, this is all the way back. Today, sugar today is trading about where it was way back in 1978, even back in this area of 72. We've never seen these old highs again. So what do we know from history? Here's oil. Now, there's a great debate raging in the world today. Does the oil chart look a lot like the sugar chart? Or does it look like the China chart? Or does it look like the NASDAQ bubble chart? And there are a lot of pundits out here today that tell us that we're going to recover this price bubble that we've had in oil. And my particular feeling is by the end of this year, we're going to see oil trading back in this range of somewhere between $85 and $90 per barrel. And I'll show you why I believe that's going to happen. But I do not believe we're going to have this free fall of a complete crash in the Dow. I believe we're going to have what I call a muddle through economy where PEs are going to compress, price to book, price to EBITDA ratios are going to compress, and that we're going to see a dramatically lower Dow, S&P, and NASDAQ over time. But I don't think we're going to have the all-out Holocaust crash that some people are forecasting. Although, as a trader and a professional risk manager, I'm not totally going to discount that that's a possibility. And nobody thought it was going to happen in Japan either, way back in 1989. And here we are 18 years later, and they're still in an economic morass over there, with a Fed trying to stimulate the economy with almost 0% interest. And people are in such a state of fear and panic that it's taken, well, almost now 2 decades, and they're not out of their challenges yet. Well, let's take a look at American history for a second. This is Globalization 2.0. It was from 1800 to 2000. Globalization 3.0 starts at around the end of 2000 and goes out here about 150 years. Now, let's take a look at Globalization 2.0. This is the performance, what I call the EKG of the American economy. And by the way, from Globalization 1.0 was from 1492 to 1800. Allegedly, Christopher Columbus discovered America. But the performance of the U.S. stock market in constant dollars over 200 years is represented in this chart here and at the bottom chart. Now, ladies and gentlemen, this was a prolific period of economic growth. More wealth was created in the world than the balance of the centuries combined. But look what happened. We had alternating boom, bust, boom, bust, boom, bust, boom, bust, boom economies. In other words, we had alternating bull-bear markets, secular bull and bear markets that lasted long periods of time. And if you want to email me, john@tradingacademy.com, I'll send you a table on exactly how long each one of those periods lasted. Now, what is a constant dollar? Because most of you are looking at, are currency traders, I guess, and many of you are looking at the world through a nominal dollar price chart. Almost all of your charting packages only use nominal. They don't use constant dollar indexing. First of all, what is a constant dollar, and is it important that you and I have constant metrics of measurement? Well, it is a dollar of purchasing power parity, adjusted for both inflation and deflation, to a basket of something. And in a moment, I'm going to show you what central banks use and what basket is adapted to. And I believe it's the most important index in the world. On the bottom chart here, I'm showing you, no, it's both inflation and deflation adjusted, Paul. It's for both periods of inflation and deflation. See, we have goods and services that have gone down in price and up in performance as well. That's what happens in a dynamic economy, okay? Now, take a look at this. This is the price to resources ratio. This gives you the idea from 1800 to 2000. It takes about 6 econometrics. It's somewhat proprietary to us, and we use it to look at a different picture of the global economy. Note that we had 1, 2, 3, 4, 5, 6, 7 irrational bull market extremes evaluation, and none of them were sustainable without exception for 200 years. These were periods where the market was overbought through the herding of irrational exuberance. Each and every bull market was preceded or followed by an equally devastating bear market extreme. And note that none of the bear market extremes evaluation were sustainable either. Now, ladies and gentlemen, here's my forecast for the future. We believe this trend is going to continue until something causes it to change, alternating boom-bust cycles. That's why we're traders. We want to look at metrics that are based on facts and around valuation. And in times of irrational exuberance, we want to become net sellers. And in times of irrational fear, we want to become net buyers. And that's why we trade. Now, I want to show you something. Here's what we believe is going to be different going forward. In Globalization 3.0, as I said, which started at the end of 2000, we're 7.5 years into it, and it's going to run about 100, 150 years, so none of us on this webinar is going to outlive it. But here's what we believe the future is going to look like. We believe these peaks are going to get higher, we believe these valleys are going to get lower, and that these cycles are going to get closer together, and that you and I are going to experience more volatility, not less. And here's why we believe that. There are 2 billion prosumers coming into the global marketplace, and I use the term prosumers because that's what Heidi and Alvin Toffler use, which is an acronym for both producers and consumers from India, China, Eastern Europe, South America, Middle East, Africa, etc. And ladies and gentlemen, the dirty little secret of Globalization 3.0 is that these people do good work. They're hungry, they're smart, and they're connected to this thing we call the internet, and they don't need to come through immigration into your country to cannibalize your income any longer. They can do it over this enabling technology we call the internet. They're going to be companies that survive and prosper. They're going to be currencies that survive and prosper. They're going to be some countries, currencies, sectors that fail. So you and I as traders, and I want to show you how we're going to identify them in Online Trading Academy, we're going to find those companies and sectors and asset classes that are going to win, and we're going to own them, and we're going to find those that are going to fail, and we're either going to short sell them or use derivatives to have a position, because history tells us that's just what happens during periods of transition. And we're in a accelerated rate of change because of this enabling technology. So I want to give you my interpretation of Globalization 3.0, and for those of you in Great Britain, please don't be offended by this, but even a beautiful English princess was not exempt from the powers of globalization that will impact all of us. So bear with me. A young English princess with an Egyptian boyfriend crashes in a French tunnel, driving a German car with a Dutch engine driven by a Belgian who was drunk on Scottish whiskey. She was followed closely by Italian paparazzi on Japanese motorcycles, treated by an American doctor using Brazilian medicine. Now, this is being explained to you today by a third-generation Irish American. That's me, using Microsoft code written in India, and you're probably reading this on your computer that uses Taiwanese chips, a Korean monitor assembled by Bangladeshi workers in a Singapore plant, transported by Indian lorry drivers, hijacked by Indonesians, unloaded by Sicilian longshoremen in a port near your hometown, to a Japan-produced truck using Saudi hydrocarbons, and delivered to your home in wherever you live by an illegal Mexican who enjoyed Italian pasta, Swiss chocolate, and French wine for lunch. Now, folks, can I have a hand on that? I worked hard on that for you last night. I think that is a glowing example of Globalization 3.0. The point I want to make is that none of us are exempt from this thing called Globalization 3.0, and it's going to have a big impact on our children, our family, and our financial wealth. Okay? Thank you, Mark. I appreciate that very much. Well, I said Africa, Boyke. We'll throw every continent in the world in there. Everybody who's connected will have an opportunity to be a prosumer. And by the way, I'm all for globalization. I want to see the economic pie get bigger for everybody. And we're accelerating. By the way, I believe there's going to be continued deflation. And ladies and gentlemen, I believe that one of the greatest skills you can have, the greatest skills that you can have, is know how to trade foreign currency, know how to trade cash and cash equivalent. And I really appreciate the great service that FX Street is providing to the global community of users to help them get education, skills, tools, and platforms to trade cash and cash equivalent. You see, in times of inflation, cash and cash equivalent is trash, but in times of disinflation or deflation that I see coming, I'm going to show you in a moment why I believe we're going to have more of it. Cash increases in purchasing power parity. When home prices fall, it takes less units of cash and cash equivalent to buy your home. Now, let me show you what the real problem is, okay? The real problem here in the United States, and it's impacting the rest of the world, because remember, when America sneezes, the rest of the world catches cold. And we are all joined in this global economy. The one thing about America, you got to remember, we are 5% of the world's population, 300 million strong. But you and I consume over 30% of what the world produces, okay? Now take a look at this. Here's the net trade deficit of the United States. Note from 1959 through 1974, we bought from the world equal to what we sold to the world, and trade was balanced. Notice from 1975 through 1992, in this section right here, we bought from the world $100 billion of goods and services, more than we sold to the world. Now that wasn't bad because we had a $6 trillion economy, and it's a relatively small percentage, $100 billion to $6 trillion. But look what's happened since 1992. The U.S. U.S. trade deficit, net trade deficit, this is net imports minus net exports, it's a net number, is alarmingly growing at an accelerated rate of change. And here's where we are today as of 2008. This is our U.S. trade deficit as a percent of annual GDP. Notice in 1992, our trade deficit was only about 1% of GDP. But notice today, it got all the way down in 2006 era and parts of 2007 to 6% of GDP, and today's at about 5% of GDP right in here. The red area here are goods and services. The black area alone is that component of our trade deficit that are hydrocarbons, petroleum, hydrocarbons. And it's not just America sending money to Saudi Arabia. Only 12% of our oil imports come from the Middle East and America. Most of the Middle Eastern oil and the Russian oil goes into Europe. America gets most of its oil from Canada and Mexico. So we can't blame this on OPEC. Ladies and gentlemen, part of the challenge that we have here is this 5-6% number of GDP is one of the highest trade deficits of any developed country in the world. We are importing over $700 billion a year of hydrocarbons into America. That means in 10 years, $7 trillion of American wealth will leave the country. And what happens when that money leaves the country? Well, it ends up in some central bank, and it gets lent back to the American consumer. We borrow money. We're borrowing $3 billion a day. And ladies and gentlemen, this is just unsustainable. Think at your personal balance sheet and income statement. If you were borrowing a relentless amount of money each day to support your lifestyle and not producing enough goods and services, pretty soon you're going to be bankrupt. You're going to certainly be insolvent. And that's one of the reasons we've seen this precipitous drop in the U.S. dollar over time. And ladies and gentlemen, the U.S. is already technically insolvent, but we have the capability to do something very few governments have the capability to do. We have the printing press. We have the ability to pay off our creditors by printing up currency, paper money, and as long as those creditors will accept our dollars for debts that have accrued and are on the balance sheet, which today is over 300% of GDP, I guess the world goes on. But every time we print that currency, it gets diluted in global purchasing power parity. And let me show you what I mean by that. This is the most important index in the world for you, for me, I don't care where you live, but it's important because central banks use it to figure out how many dollar-denominated assets they'd like to own in their to back their currency. This is the U.S. dollar trade-weighted index. It trades as a futures contract. It is a basket of currencies issued by sovereign governments. Here's the weighting of the basket per currency in euros, Swiss francs, Swedish kronas, Canadian dollars, British pounds, and Japanese yen. Notice that the Chinese yuan is not in this basket, and we've had a $1 trillion a year bilateral trade experience with China. Why isn't the Chinese yuan in this basket? Because it's a major trade partner for we Americans. Okay? Let me show you what the price of that basket has been in dollars. In other words, if you take all those currencies, throw them into a basket, and then price that basket in dollars, okay, is because this is the price of how that basket has traded since the mid-'70s, when 1971 Richard Nixon took us off the gold standard, and therefore all the world became part of the gold standard. And you're right, Juan. The reason the yuan is not in this mix is because for 25 years, Central Bank of China has had a fixed exchange rate, 8.2 yuan equal $1. Recently, we've had a dirty flow to the yuan. It's now down to about 6.8 yuan to the dollar. And the U.S. government is trying to talk them into letting it float freely. And there are pundits that forecast it could go to 4 yuan to the dollar, which means that all the costs of goods that China produces for the retail sector across the world are going to get a lot more expensive at your local retailer or your local Walmart, for those of you that have Walmart in your community. So and secondly, if they had a 4-to-1 exchange rate or a 5-to-1 exchange rate with the yuan, they're going to have a very strong currency at which to go out and buy global sourced hydrocarbons. So I'm not convinced that we need to be pushing them to raise that currency valuation that much, because they are the job shop to the world. Now, note that we are in a bear market for the U.S. dollar index. We've had a little rally recently. It came off a bottom of around 72, and today I think it's trading at about 76 cents. But this has gone from $1.65 down to 76 cents. Now, I want to take this section right here since 1992. This is this section right here, and I want to blow it up, and we'll look at it a little bit closer. This is the U.S. dollar index, which is, again, the price of that basket from 1992 through 2000, start of 2008. But again, today it's trading right down here by the red arrow at about 76 cents. I want you to note that the peak of the U.S. dollar trade-weighted index for this chart was $1.24, but in the previous chart, it was $1.65. Okay? Today it's trading at about 72 cents. Okay? The fours are the 4-year cycle of the U.S. dollar peak. Okay? Now, this is a quality of life issue, folks. If you had $1 million estate in 2000, the global purchasing power parity of your estate would be founded by taking $1 million times 1.24. That tells you you have a $1.24 million net global purchasing power parity. If the purchasing power today is 76 cents, you have $1 million of assets. You'd take $1 million times 76 cents, and you have in a dollar-denominated estate, you have about $760,000 in net purchasing power. So how do we apply this to dollar-denominated assets? Well, I can apply this. This happens to be the Dow Jones Industrial Average from October of 2002 through roughly middle of 07. I'll show you where it's at in a moment today. But remember, the Dow is priced in nominal dollars. Okay? Now let's show you how we compute this in Online Trading Academy to come to the conclusion that we are truly in a secular bear market. The Dow peaked in 2000, and by the way, the Dow Jones Industrial Average is an index of 30 stocks. 40% of their earnings come from global trade. Coca-Cola, as an example, has 70% of its earnings come from the sale of sugar water throughout the world. And they take those foreign currencies into their income statement, convert them into dollars, and report earnings to shareholders. 40% of the earnings of the S&P 500 are the same thing. So let's take a look at this. The Dow peaked in 2000 at 11,700 nominal price. You multiply that by $1.24, which was that peak in 2000 for the dollar index, you see that the Dow peaked at 14,508, what I call global purchasing power parity points. And in my world, that's the only thing that counts. How many goods and services will my dollar buy me? Because as an aggressive consumer, I buy goods and services all over the world, either directly or indirectly. There is a foreign currency transaction in the background. Let's assume the Dow today is at 12,000. It's actually at about 11,500. But let's just give it the benefit of the doubt and assume it's at about 12,000 Dow. I got to multiply that by roughly, in this example, 73 cents, which tells me that the Dow trade weighted index today is really at 8,760 points. So if I do the math and subtract the little number from the big number, that's a deficit of 5,748 points. Divided by the big number, it tells me that since March 10th of 2000, the Dow has lost over 39.6% of its global purchasing power parity. And ladies and gentlemen, that is a bear market. You're looking at a chart like this that it gives you the illusion or the perception is that we're in a nominal price bull market, but in constant dollars, ladies and gentlemen, we are in a bear market, and this is what it looks like side by side. At Online Trading Academy, we will teach you that there is a gap between your perception and reality when it comes to valuation. So what I recommend you do, if you're going to price, and there is a currency risk when you buy and sell securities, because you have to make settlement in some currency, and now with ETFs, we can have exposure to companies all over the world that not only source goods and services in multiple currencies, but make settlement in multiple currencies. We have to know what is the constant dollar purchasing power. Now, I could also do an index for the constant sterling. I could do an index for the constant euro. But wherever you are located, you need to adjust the currency and have a consistent metric of measurement. This is what it looks like in dollars. And the dollar is a great place to start because access to the data is very, very easy, even though you may live in a country where your income and outgo is priced in another currency. The blue chart here is the nominal price Dow, and the red chart here is the constant dollar Dow. And ladies and gentlemen, if you're making decisions thinking that we're in a new bull market because of inflated assets, we're not. In fact, in constant dollars, the Dow is dramatically down. And let me bring this point home very clear for you, because your pension plans today have a big exposure, if they have any American exposure at all, the following companies: GE, Microsoft, Cisco, Amazon, Ameritrade, Schwab, GM, and Dell. I took the peak. These are great companies. I highlight them because they're not only global multinationals, but they source goods and services all over the world, and they distribute their goods and services all over the world. Now, I took their peak price in 2000 and multiplied it by 1.24. I took their price as of, say, Monday's close and multiplied it by 76 cents. And this is how much these companies are down in net purchasing power parity since March of 2000. And my position is that these assets are part of the corpus of teachers, firemen, police, pension plans, possibly yours, all over the world. And unless you understand the currency risk when you buy and sell equities or any other asset, including real estate, you are grossly misvaluing where we are in the economic cycle. Here is another chart that I find very, very enlightening in how we determine valuation. Then we'll start to open this up to some questions. The premise of this chart is that the nominal Dow was following the lead of the real Dow. Now think about that for a second. The nominal Dow Jones Industrial Average is following the lead of the real Dow. Now let's define our terms. The real Dow is on the right axis over here, and it's defined as the Dow Jones Industrial Average divided by the price of gold. The nominal Dow is on this axis to the left. And notice as the real Dow, right here, plunges, the nominal Dow follows it. Now, this chart is for 30 plus years, okay? And notice that everything changed right here in 2002, where we got divergence, okay? The divergence shows us an escalating nominal Dow and a precipitously falling real Dow, and I'll show you the numbers in just a moment. But ladies and gentlemen, this bearish trend, when we saw this in 2002 and we saw this divergence, it allowed us to give our clients a heads up, and we changed our trading plans. Now, why am I using gold? What is gold? Why am I using gold as my denominator here? I'm not using the dollar trade weighted index. I've already showed you that index. This is my second metric of constant indexing, and I'm using gold as my denominator. I'm taking the nominal Dow divided by the nominal gold. Why am I using gold? What is gold? What do you all know about gold? What is it? Come on, folks, give me some feedback. Yeah, it's a hard asset. What else is it? Yeah, it's a hedge against inflation. It's also a hedge against deflation. What is gold? Here's what I want you to understand about gold. Gold is a world currency. Thank you, Mark. It is the world's only real currency, and it has been such for over 3,000 years. Ladies and gentlemen, all paper money is convertible into units of gold at some ratio, and let me tell you why we like gold as our denominator in this example to be our constant metric of measurement. No central bank in the world can print gold. Let me say that one more time. Think about this for a moment. No central bank in the world can print gold. I hope you understand the power of that message, okay? It is extremely important that you understand that, and it is in times of economic turmoil and uncertainty, be inflationary based or deflationary, credit crisis based, gold has been a safe refuge. Now let's take a look at this chart. This is what we call the silent crash chart. In 1980, it took 1.38 ounces of gold to buy the Dow. This was the real bull market. Ladies and gentlemen, the real bull market is over. It ended at 44 ounces of gold in 2000, and then since then it has declined today below 15 ounces of gold to buy the Dow, and this is a real chart. The Dow Gold Index, we call it, is down over 72%. The constant dollar Dow I showed you in the previous chart is down 39%, but the real Dow is down 72%. And if you're out there making buy and sell economic decisions thinking that we're going to have a new bull market, you need to reassess that situation. Ladies and gentlemen, we are in a bear market. We are in a secular bear market for global purchasing power parity for the Dow, the S&P, and NASDAQ, and the numbers look worse for the S&P and NASDAQ. Let me show you a chart, and then I'm going to show you two more, and I'm going to open it up to questions. This is the 80-year Dow Gold ratio. Nobody's ever showed you this chart before. You've never seen this on CNBC or Bloomberg, okay? No one has ever published this, so thank FX Street and Online Trading Academy for bringing you this content. This is taking the Dow Jones Industrial Average nominal price divided by the nominal price of gold for 80 years and putting it on a chart, and this is what it looks like. From 1928 to 2008. This red line here is the average of that ratio. In 1929, it took 17 ounces of gold to buy the Dow. This was the Great Depression. This was the bull market coming out of World War II. It was a real bull market. It took us up to 27 ounces of gold to buy the Dow. Remember, this is the average, the red line. This is the bear market coming out of 1966 all the way into Reagan's election right here in 1981, and coming out of Reagan's election right here. This is what the bull market looks like, to a 44-to-1 ratio right here to peak, as I showed you in the previous chart right here. Ladies and gentlemen, here's where we are today, right back to the long-term average. It's not a moving average, that's the long-term average. In other words, if your grandfather had bought you a unit of the Dow in 1929, it bought you 17 ounces of gold. If you were to liquidate it today, it's only going to pay you about 12 ounces of gold right here. So what I want you to do every Friday is this, and add the next tick to this chart. Take the nominal Dow divided by the nominal price of gold, and you put the next tick on the chart, and you and I will follow and see where this thing goes. All right, I'm going to go forward a couple of slides here because I want to show you something that I think is important. I just got back from London. Part of our global credit bubble is bursting, but take a look at this chart. If I look at Germany, US, and France, our subprime mortgages, this is that toxic paper the mortgage industry underwrote. These are total residential mortgages-backed securities issued as a percent of GDP. In America, Germany, and France, it's only 0.5%. We issued $2.5 trillion of toxic paper, but we've got a $14 trillion economy. Look at the UK. As a percent of GDP, it's 7% of GDP in the UK. In other words, ladies and gentlemen, the amount of toxic paper circulating in investment funds in UK is 14 times the problem as it is in the United States. In Ireland, it's 6% of GDP, which means their problem is 12 times that of the United States. In the Netherlands, it's 5% of GDP, which means it's 10 times the U.S. So, ladies and gentlemen, here's my prognosis. I believe we're going to have a consumption-led continued recession. The global credit bubble is now leaving the shores of America. It's come to the shores of Western Europe, and you're going to go through what we went through for the last year and a half as your banks start to take write-downs on all this toxic paper that's carried on their balance sheets. There's going to be a slowing of the real estate sector, which is a big piece of global GDP for all developed countries and cities. I think you are going to see it hit the shores of Europe. I think it's already started, and it's going to be reflected. I'm looking for softening prices. You're already starting to see the pound sterling and the euro fall against the U.S. dollar. I think we're going to continue to have a strong dollar through the rest of this year because I think we've already taken a lot of our pain. But I believe globally, we're in about the second or third inning of a 9-inning ball game. In other words, we got a long way to go. It's going to cause a global recession. I don't think we're going to have a depression, but I think we're going to have a massively slowing, lingering, muddle-through economy, and there's going to be a lot of pressure. The number one asset you want to own in times of deflation and disinflation is some precious metal. I think you want to own some hard currencies, okay? And I think the dollar is probably going to be a relative better store of value than the euro, the pound sterling, maybe even the Swiss franc, very much for the rest of this decade. God bless you all. Good luck. I'd like to open this up to questions. If you have any questions you would like to ask me, you can email me. My name is John. My email address, is john@tradingacademy.com. I hope you will visit our website, tradingacademy.com, and we got a lot of free webinars there. And I certainly hope I can answer any questions you might have. And whenever the moderator would like to cut me off, that would be just fine. But I'm here to answer whatever questions you might have right now. Thank you very much. God bless you all. Good luck. I hope all your trades are green. Abdul wants to know what factors determine the value of a currency. Obviously, it's supply and demand. That could be a whole seminar in its own. We have a whole 6-day course on that concept. There are a lot of factors that determine. We've got some free CDs at our webinars at our website, by the way, too. Can you tell me how this will impact foreign currency trading? Yes, I believe currency trading is going to continue to be very volatile. I think you need to be cautious how you handle all the leverage in currencies. A lot of you are using 100, 200 to 1 leverage, and I don't think you're prepared to handle it. I think you need some more education on technical analysis, especially Fibonacci ratios, to use that kind of leverage, and good risk management discipline. How does this pan out for gold going forward? Short term, I'm bearish on gold. I'm looking for gold to go down and test mid 700 level. And then long term, depending on how much crisis we get into with pain, I'm very bullish on gold long term, because if you look at the long term charts of gold, certainly since 2000, gold has outperformed every fiat currency out there. Why would the U.S. go up against the euro and the British pound? Because, ladies, it's already happening, and we've gone from the dollar index in 70 to 76. It's really already taking place. Okay. because your crisis in Europe and Great Britain, real estate is just really getting started. We're a year and a half into it, and usually, if you have a really weak economy, U.S. dollar's already taken a hit. It's gone from $1.65 down to 76 cents. My web link is tradingacademy.com. That's tradingacademy.com. How much gold is there backing a dollar? Probably about 5 cents, maybe 3 cents. Okay, if you want gold, go buy some gold. The best way to own gold, if you don't want to own, best way to own gold is GLD. It trades on the New York Stock Exchange, or go get yourself some gold coins. Folks, I've got to go. I'll write in my web link here. It's www.tradingacademy.com. Thank you very much. Thanks to FX Street for their opportunity to address you folks. Stay in touch. Send me an email. God bless you all. Good luck.